Hi millionaires! Today I'm gonna tell you about MACD and stochastic trading strategy. It's a simple strategy to get a profit from financial market. This is my first video in English, so I will talk very slowly, and at the beginning I will do a lot of mistakes. I haven't had a practice of conversation for a long time. So don't judge me harshly and just take my ideas for your trading. I believe that my ideas will do your profit. So let's start. So first of all, let's add stochastic indicator to the chart. I am using standard settings. It's 533. So stochastic oscillator compares the stock closing price to its price range over a period of time. Its K line, at the moment it is blue line, indicates the number of time periods. And a D line, it's a yellow line, is the moving average of the K line. Then the key line drops below 20, the stock is oversold, and it indicates a buying signal. If the K line peaks just below 100, then retreats, the stock should be sold before the value drops below 80. And generally, when the K value rises above the D line, it's a buy signal as long as the values are below 80. If they are higher than 80, security is overbought and it is a sell signal. So next we add the new indicator MACD. With the standard settings it's 12, 26 and 9. MACD indicates price, trends and direction. Subtract the security 26-day exponential moving average from its 12-day moving average to create an oscillator indicator value. The trigger line is the 9-day EMA. At the moment it's red and green. Green indicates that it is an uptrend and the red line it's a downtrend. If MACD value is higher than the 9-day EMA, it's a blue line. It is bullish moving average crossover. A bullish signal occurs, then a faster moving average crosses above a slower moving average, creating market momentum and signaling more prices increases. Then, using the stochastic oscillator and MACD together, look at the bullish crossover here that occurs within 2 days of each hour. The MACD should cross slightly after the stochastic. Otherwise, a false price trend indication may appear. So here is a strategy. So let's talk about buying and selling rules. First of all, the buying rules. MACD must be above the zero level, and this indicates uptrend. So let's find where MACD is above the zero line. It's here, for example. So next, the stochastic indicator must have a crossover at oversold region, which is around the level 20 line. So let's find this part for stochastic. It's here. So on the high of the candlestick that corresponds to 2 lines of stochastic crossing over, place a buy stop order a minimum of 2 pips above its high. So what does it mean? It means that we need to enter market on this candle, and we need to put stop loss at least 2 or 5 pips below the low of a candlestick. But if you see that it is going to be too close to the entry price, then look for the nearest swing low. Nearest swing low is here. So stop loss will be here. If you don't know how to find the lastest swing low, I could offer you to use zigzag indicator. So let's just put zigzag indicator, and parameters will be 6, 5, 3. So now I see the last swing low, and below this I put a stop loss, and entering is here. because stochastic show me that I need to enter, and MACD is also above the zero line. So where is my take profit? Actually, take profit synchronous with risk reward rule. For me, it's 1 to 2. But the simplest rule is that previous swing high will be take profit. So the previous swing high is here. So this will be my take profit. Why I need to know where is my take profit and where is my stop loss? I need to see risk reward is actually met. So if we entering at the new candle, so let's now calculate if the risk reward ratio will be met. Risk 0.1%, and if price will go to the previous swing high, it's 0.2%. Yes, it's met the risk reward ratio. Now let's talk about the selling rules. The selling rules the same as the buying rules, but in opposite side. MACD must be below the zero line level. This indicates a downtrend. Stochastic indicator must have a crossover at overbought region, which is around the level 18. On the low of a candlestick that corresponds to the two lines of a stochastic crossing over, place a sell, or you can enter by market. Place your stop or loss order at least 2 or 5 pips above the high of a candlestick. But if you see that it is going to be too close to the entry price, then look for the nearest swing high and place it 2 pips above it. Aim for a risk reward is 1 to 2 for your take profit target. So another option is to use the previous swing low as your take profit target level. So let's find it on a chart. MACD need to be below 0. So it starts from here. Next, we need to find place where a stochastic is overbought. It's here. Now, we need to find the stop loss. If we enter on new candle, it's here. The stop loss above this candle that indicates the crossing over for stochastic. If we calculate how much stop loss have pips, it's only 12. Actually, it's too close, so we could put, as the rule said, above the previous swing. So the previous swing is here, like we see with the zigzag indicator. So stop loss we put here. This is our stop loss. We need to know where price could go. So if stop loss is 25 pips, so we need to 50 pips to get take profit. So it's here. We need to set stop loss at least 2 or 5 pips above swing high. My advice is to use 5 to 10 actually pips. It's from my practice. If you have some questions, so don't hesitate and ask me. You can call me by Skype phone, or you could write by email. So bye.